Looks great.
All right. So as Anna mentioned, tonight we're going to talk about the idea of turning your hobby into a business, and the main consideration here is we're kind of prefacing this idea of farm budgets is kind of a main theme, and we'll kind of get back to why that is a little bit when we start to think about going from a hobby into a business. I wanted to highlight that a couple of main topics we're going to really cover is thinking about what is a farm business. And with that, talking about employee identification numbers a little bit, these EINs that typically come up in conversation. We'll talk a little bit about tax exemptions, business structure options, and then also business planning a little bit. We're also going to talk about what are farm budgets, as well as finding the cost of production. We really want to focus on thinking about the idea of going from the tax view to more of a production viewpoint. And so we'll kind of spend a little bit of time on that. And then finally, kind of wrapping up with thinking about why details are really a must for success in your operation before we highlight some resources we have here at MSU. So let's jump right into this idea of what is a business versus a hobby. And we like to generally start by referencing back to the IRS because they're typically a very good source of a standard definition of what makes up a farm business. Now, one of the things I have up here on the screen for you is what's called the Farmer's Tax Guide. It's publication 225, has a lot of great information, especially when you go to file taxes as a farm business. There's even some helpful information in there if you're still kind of more of the hobby side. But one of the things inside of the Farmer's Tax Guide is this really neat definition of where a farm business or a farm is considered a business if it cultivates, operates, and manages for profit. And the key phrase here is for profit. Because when we think about our farming activities, everyone, even if you're a hobby, you're managing that farm, you're operating the farm, and cultivate can mean a lot of different things from a farming practice, but it's this idea of operating for profit that really stands out. And that's because from the IRS standpoint, if you're in business, there's kind of this presumption of profit that goes along with it. And what they'll look for is when you look at your taxes, if your farm produces a profit in 3 out of the last 5 tax years, then according to the IRS, you're a farm business and not a hobby. And so it's important to always make sure you're filing taxes and you're providing the information of your income and expenses from the farm to be able to showcase in your taxes that you're making that profit. Now, 3 out of the last 5 years sounds really simple, but that's not always the case for startup farm operations. For some farms, it takes a little bit longer than 3 out of 5 years before you're really going to start to see some income generated. And that may be the case for many of you as you're working with your bees. Depending on what you're looking to do as a farm operation, you may not see that profit in those 3 out of 5 years. Well, the IRS recognizes that, and they know that some operations take a little bit longer to kind of get started. And so they'll extend that period. Instead of 3 out of 5 years, they'll look more at 2 out of 7. So they'll reduce the number you have to qualify and increase the number of years they're going to look at, as long as you're carrying on activities to seek profit. Now, the IRS is all about key phrases. And so we had before where you're operating for profit. And now we've got this phrase of seeking profit. Well, that always kind of generates the question of how exactly does the IRS decide that your farm is seeking profit? Now, what typically happens is when the IRS gets to the point of they're questioning whether your farm is a business or a hobby, they're typically going to run an audit and want to look at some information. And so one of the first things that they look at is what the method of operation is on the farm. Are you operating in what's considered a business-like manner? Are the efforts you're making, are the activities you're taking on really kind of what you'd expect from a business? Are you out working with the bees every day? Are you kind of maintaining things like you should be? Or is it you kind of get to it when you want to because it's more of a hobby? It's more of a recreational type thing. And there's kind of things they'll look at for that. There's also this idea of any business losses that you've experienced, are those from circumstances beyond your control, or are they considered normal startup costs of farming? And there are cases where you're going to see losses in the first couple of years, typically, depending what you're doing, as you're trying to get things started. And that's what kind of comes into mind when we think about this idea of the expectation of future profits, which is something the IRS will also look at. And there's this key phrase that they use of the future profits are expected from the appreciation of assets used in the farming activity. And when we think about this idea of appreciation of assets, it's kind of a cumbersome set of phrasing there. But really, what they're talking about is that when you start off an operation, especially when you think about starting your bee colonies, you're not making money off of those on day one. It's going to take you some time before you've got the colony built up. If you're looking to sell honey, the honey is at a level you can actually sell and make some money. You may be looking to do some service in terms of selling the bees. A lot of different avenues of a farm business that it takes time before you get to that point of having something to actually sell and make some money from. And we see this often cases in other types of agriculture. Fruit trees are a really good example of this. You plant the tree, and it may take upwards of 4 or 5, maybe 6 years before you really see good production out of it. And so we get down to this basic idea of, well, if it's not making money today, but down the road it's going to make money, it's worth a lot more money to us down the road. It's got more value to it. It's appreciated in value because it went from not making us any money to making us money. And so the IRS will look at that aspect as well. They're also going to look at profit motivations. Is the time and effort spent on farming kind of something that indicates that you're really trying to be profitable? It kind of goes back to that business-like manner a little bit. Do you depend on the income from the farm to help pay for your family living, your livelihood? And then do you also kind of change your methods of operation in order to try to improve your profitability? We're always trying to self-evaluate our operations, say, can we be better? And we'll talk about that a little bit more in a bit, but they'll look at that as well and try to determine, are you trying to make improvements where it makes sense to increase profitability? They're also going to look at historical performance. If you've farmed in the past and been successful using similar methods, maybe it's the same type where you had a bee operation somewhere else. Maybe it was a different type of agriculture, but the way you went about managing that farm proved to be successful. They consider that as a helpful information to say that, yes, you are operating in a business-like manner. And in some cases, maybe you've made some profits in some year, but they're going to look also at the amount that you earned. Did you make $5 one year versus maybe making $1,000 the next year? Those kind of big differences. What's the amount of profit that's being made versus something you'd expect from a business versus maybe something that, again, would be more of a hobby. And then they also consider, when you're trying to seek profit, do you and the folks maybe you're getting as advisors, whether it's someone in marketing, a lender, maybe it's someone like Anna or myself in extension, do those folks have the needed knowledge to carry on a successful business and are giving you that good advice? And do you yourself have that knowledge to be successful? Those are all kind of things that they like to look at to figure out, are you a farm business? Now, when we look at the IRS definition, there's another question that comes up. Does a farm need to become a business? Do you have to transition from a hobby to a business? And that choice really rests with the farm owners. And there's a couple questions that maybe you want to think about. Does tracking expenses or the for-profit activities that were described by the IRS that you need to do to kind of verify that you're a farm business take away from the enjoyment you get from what you're doing on the farm? And is the beekeeping more for recreation, or is it adding to your family income? So again, do you need that money to kind of pay for your livelihood? And even if you decide that, farm businesses just isn't for me, you want to make sure as a hobby farm that you're still reporting any income to the IRS. Even if it's just something like you're selling honey to the neighbors, you still have to report the income, even as a hobby operation. But there's no reason why you have to become a business. It's perfectly fine to stay a hobby. Now, there are some benefits of going into being in a farm business. There are tax deductions. So any of the capital assets that are purchased can be what's called depreciated and treated as an expense, because in a farm business, you can use your farm expenses to offset the farm income. And so you've got less taxable income that the IRS can look at. And so that is an advantage, that anything you buy as a capital asset that's kind of beyond your normal yearly input costs, yearly supplies you have to buy, you can actually set up to expense that cost of that purchase out over 1 year or multiple years. The length of years depends on what it is you actually bought. And so that's an advantage that farm businesses have from just an IRS standpoint. The other thing that comes up is that farm businesses don't have to pay sales tax on inputs. At least that's the case here in Michigan. I know we've got a couple of folks from other states. I would imagine that's the same true for several of you folks out there. The main thing that we remember is that the sales tax is on the actual yearly supplies or inputs to operating. It doesn't really apply to anything like a capital purchase. So if you bought a truck for hauling the bees, for moving the honey to a market, those type of things, those capital assets, you can't really get the sales tax removed. But for the actual items you can, it's relatively simple. There is a Michigan sales, it's through the state. So it's a Michigan sales tax form, form 3372. And the nice thing is you can either go to the state of Michigan website to download it, comes right up in a Google search, or in a lot of cases, the farm retailers or retail outlets that you may be working with, a lot of them typically have it on hand already to help you fill that out and make sure they've got it on file that you're operating as a farm business and can qualify for that tax exemption. So that's a really nice thing to be able to add into. Now, another question that often comes up when people start thinking about businesses is this idea of an employee identification number, or an EIN. And so we're going to talk about what this is and whether or not you really need one, because that's probably the biggest question is, do you need an EIN? Well, the first thing about an EIN is it depends on the business structure you're using as to whether or not you need one. If you're operating as a corporation or a partnership, you are required to get an EIN for your operation. Now, limited liability companies, which are very popular for farm operations by and large, only require an EIN if there are 2 or more members to the LLC, or if you're a single member and you're going to hire employees. A lot of times people get confused that, well, I'm getting an LLC, I have to have an EIN and go through the process of getting that number. And that's not necessarily the case. If you're a sole proprietor where it's just you and you're not in a legalized form, you're actually use your own tax ID number or your social security number to actually operate under, you don't have to get an EIN. You can if you want, it's just not something that's needed. And what we find is that most of our small and beginning farms are sole proprietors. So there's kind of this misnomer that if you're in a farm operation, you have to have one. But depending on what you're doing on the farm really influences the type of structure that you're going to be using. And depending on that structure, then you would need to get an EIN or not get one. Now, if you decide you need one or you'd like to get one, the question is, where would you go? You can go to the IRS directly and apply for one online. It's form SS-4, and you can submit that to the IRS. So this is a federal level thing. It works for all states. You can have your tax accountant assist you with that. And so it's really not that hard to get one. I know a lot of farms that have them. Some cases they need them, some cases they don't, but it was relatively simple process to get one. Now let's take a step back from that for a moment, talk a little bit more about these business structures, because I mentioned depending on what you're trying to do, influences which business structure you want to be in. And so what I've got outlined here is these different business structures. Sole proprietorship is kind of where everybody starts out at. You can go into farming as just yourself. You're one person, you are the business. If you go into a partnership, it's very similar to a sole proprietor, but you're really just dealing with more than one person. An LLC offers some liability protection similar to what you get at a corporate level if you're thinking of a corporation, but without some of the startup complexity that comes with being in a corporation. And so when we think about these three business structures, they're very popular because of this idea they're easy to form and even easy to exit. But as you kind of, as I say, kind of move down the list or move up the level of structure you have, there are some add-on things that you start to run into. With a partnership and with an LLC, you need to make sure you have balanced books. Again, if you're in an LLC, and especially if it's just you and you're going to hire employees, that's where you want to make sure you've got payroll information. That's where an LLC kind of helps in some cases. But you start to run into government payment limitations when there are programs that you're eligible for. And so those start to weigh into, do you need to be in that business structure? Does it make sense? An S Corp, some people like an S Corporation because it's kind of in between a C Corp and an LLC. In a corporation, you have to track any wages that are received, but then you can also split the income that's received from the farm, and it operates in what they call a pass-through motion. In an LLC and a partnership, what's a really key thing to remember is when the farm has income, it what they call passes through to the individual's tax return. And so if you're a one-member LLC, if the farm made any money, that's going to pass through onto your personal tax return. You're going to show that as income. If you're two members of an LLC, depending on the percentage, say you're both equal shares of the partnership or of the LLC, excuse me, 50% of the income goes to you and 50% goes to the other member. The S corporation will do the same thing. It just has some advantages where you can track some things as potentially wages on the operation, but it gets to be a little bit more complicated with that extra level of detail with that. The C corporation, it files its own taxes. Everything is kind of contained within. The only money that you would receive is an actual wage from the farm. And so you can see all these X's. You've got a lot more complexity as you get into the corporate level. What I recommend for people as they're thinking about going into a business, if you're just yourself and you're not going to hire any employees, you're fine at a sole proprietorship. You don't need to go up the extra levels. But as you're looking, depending on what liability concerns you may have, the number of people that are involved in terms of partnerships or family members that want to become partners, then you want to start to explore this idea of, do I need something other than a sole proprietorship to make sure that we're tracking things the way we are, we're handling our taxes the way we need to be, and making sure that we're managing any liability concerns that come with the operation. And that's generally the best way to think about which structure fits the best for your farm operation. Now, we've talked about all these different aspects. One of the questions that often comes up is, when should this transition to a business happen? And that really depends on a few factors. Maybe the income has reached a level that there are significant tax implications. And so some of those advantages that we talked about earlier are maybe really enticing because you're going to be paying an awful lot in tax liability that you maybe want to try to offset. The other thing is that maybe expensive has reached a level that the hobby is no longer affordable. Some friends of mine the other day really gave this great quote to me where in some cases, a business is a hobby that got out of hand. And so maybe those expensive has reached that level where your hobby is now out of hand and you need to go into that business to try to generate more income and to make this more affordable. The other aspect is maybe you've just got a personal choice and desire to pursue that business. And so if those are factors you're thinking about, those are situations when you want to look at that transition from going from hobby to a business. Now, once you've thought about, should we transition, the next question becomes, how should we transition? And I would recommend people that wanting to make that transition to a business, the simplest way is to start with getting a separate checking account for the new business. Checking accounts are relatively easy to open for the most part. You can also open a savings account for the business, but that's not always needed. You may have situations where you're wanting to have a savings account for your business. That's fine. In most cases, just a separate checking account to separate your income and expense from the business from your personal income and expense really helps. And that's a good first step to really look at, do we want to go into this business style model, and you can go about getting a checking account. Then decide which business structure really works best for you. And thinking again of what you're trying to do, what are the liability concerns, how many members are involved, are we hiring employees? And once you've decided what structure makes the most sense, then you can go obtain an EIN number and file the proper paperwork if that's something that's needed. Let's then talk about how we kind of get started in terms of developing our business model. And the first thing that I think is really good for people to think about is developing a business plan. Now, a business plan, when people look at these, they're really overwhelming. There's a lot of detail to them. And so what I want to talk about is kind of taking a simple approach to these, because ultimately, your business plan is a blueprint of how your business starts. And there's these different sections that may be a little hard to see on the screen, but we talk about business descriptions, operations, management and organization, marketing plans, and financial plans. That these titles seem kind of ominous when you think about them. But really what we're trying to get to is your business plan is that blueprint of how your business starts, and then the guidebook of how that business intends to grow. So let's think about how we kind of simplify getting into this process a little bit. A lot of cases when people start to talk about business planning, they jump right to this circle of activities. We start to want to talk about our mission statement, what our vision is, our core values, and our goals. And these are very, very important things. You're going to want to spend time thinking about these as you're developing your overall business plan. But I think you can take kind of a simpler start to approaching this idea and really ask yourself three really key questions that really kind of get to the heart of what you're eventually going to kind of define more in depth when you write out a mission statement or a vision statement. And the questions start out with simply, what are your beekeeping passions? What is it that you really love about beekeeping? Is it the bees? Is it the ability to process and sell honey? Is it working with other farmers to make sure that they've got good pollinators for their crops? What is it about beekeeping that you really enjoy? And then ask yourself, do those passions translate into a business? Do you see opportunities where that could potentially be a business for you to pursue? And then if the answer is yes, the next question is, what goals do you want to achieve within your business? And eventually what you'll do is you'll come back to these four components, and you're gonna kind of really define these more in detail and really spend the time to put this information into kind of this model. But I think these three questions get you started to really get into the business plan from what I consider probably the most important part of doing any kind of business plan. And that's starting with your marketing plan. And this seems very backwards from a lot of places that you're going to talk to on business planning, but I approach it really from the standpoint that farm businesses must have products that consumers are willing to buy. If they're not going to buy it, you're not going to have any revenues, there's no sales, and there's no profit. And so you have to think about the markets and the market strategies that you want to get into as a farm business. As we think about beekeeping, what are you marketing? Is it honey? Is it the bees themselves? Maybe there's some agritourism type things that you're interested in. What is it you're looking to have that you're going to be able to market out to consumers that would be of interest for them to buy? Then we have to think about, how are you going to market? Where are you going to market? And then also, who is your competition in that market? Because there's maybe a lot of other people doing the exact same thing, and you have to start thinking about, what would you do different? How are you going to separate yourself from the competition? And what are some things to kind of pick up on to know what exactly it is you're going to have to be thinking about to separate yourself overall from everyone else in the market. And so some of you may be familiar with this concept of the 4 P's of marketing, where we talk about product, price, place, and promotion. And really what we're doing here is, this is a fancy way of talking about the same 4 questions that I just went through. When we think about the idea of a product, what are you marketing? Is it going to be based on, is it something that's going to have features, or is it a certain type of quality you're going to sell? Maybe it's branding or packaging. Earlier on in the presentation, I had some slides up that show different types of honey that was being sold, some in the jar, some in the squeeze bottle. Is that how you're going to differentiate honey if you're selling it? If it's bees that you're offering as a service to crop growers of some kind, how are you, what's your product going to be? And then we think about, how are we going to market? We're really talking about this idea of promotion. What are we going to do to really get our information out to consumers, to let them know that, hey, we exist. We have this product for you to buy that we want you to take a look at. And then, where are we going to market? Where's that place we're going to really focus on doing that promotion at? Maybe a number of things, maybe a matter of location that we're at. Maybe it's through certain marketing channels. It may be a case of, part of the places, hey, we're going to come to you. We're going to bring the product to you if you got a delivery type service. And then ultimately, price gets kind of back to this idea of, who's the competition in the market? Who, are you dealing with price things that you have to think about your pricing strategy? Are you going to run through different payment terms or options to differentiate yourself in the marketplace? And a lot of times we talk about this marketing mix, and we're really just trying to think about how we're going to answer those 4 questions over on the left side of the screen here, to really get ourselves into a position where we're in a market that we feel we've got a product, and we feel confident we've got a product that consumers are going to be willing to buy, that really shape the rest of our marketing plan, the rest of the development of our business. Because once we've thought about that, the next thing is to think about the idea of a SWOT analysis, where we identify these internal and external factors that are helpful or harmful to achieving the farm goals. And we look at strengths, weaknesses, opportunities, and threats. What do we do really well as a strength? What are some ways that we can get better, improve as a weakness? So that's a harmful and internal type thing. Strengths are helpful but internal. What are some external opportunities that may be available that can help us? What are some external threats that we need to be worrying about that maybe can be harmful? But I recommend people go a step further, because a lot of cases people will do a SWOT analysis, they identify all these things, and then they stop. What you want to do is go into more of an active SWOT analysis, where you're not simply asking, well, what is that? You focus more on, okay, what do we do about it? How do we leverage our strengths to make sure that our business is getting the help it needs? How are we mitigating or reducing the weaknesses or the risks that are out there? Are there opportunities that we can exploit, and how are we going to exploit those? And then if there are threats out there in the marketplace that we have to be worried about, how are we going to dissolve or mitigate those threats that we're facing out there? So you want to be thinking proactively, again, back to this idea of how you're going to market, what's the competition out there. You want to think about what it is that sets yourself apart internally, what are those external factors you've got to work on, and think about how you're actually going to go about doing that. And once you have, then you kind of come back to the rest of the market, or the rest of the business plan. You can talk about the description, the business description, where we get into, who are you? What do you do? What's the farm's kind of identity? Where are you located? Who are the farm owners? And then we think about, what business structure are we going to operate in? And then we can talk about management and organization, where we think about, well, who's involved in the business? Who's part of the management team? How are tasks being divided amongst the management team? How are employees being managed? What professional services are part of your management team? You're working with a lender, a sales broker of some kind. Can even be folks like Honor and myself at Extension. We fit in that management team. Kind of a similar theme that we talked about with what the IRS looks at. Business plans looking at who's part of that, who's your advisors, who's part of that management team. And then you can think about operations. What is it you're going to produce? What are the methods that are used to produce it? How are you managing your methods? And then what risks are you exposed to, and how are those managed? So we go back to that SWOT analysis. A lot of those pieces, as you're thinking about that market, they end up filtering into some other places in the business plan. And so that's where I'm kind of atypical, or kind of the opposite of most atypical people that go into a business plan. Is your marketing and thinking about the market you're entering is going to help answer some of these other questions that you can further define in your business plan. Now, I'm very similar on a lot of folks when it comes to business plans, that you're going to finish with your financial planning. You need to know, does this business plan make financial sense? From a dollars and cents standpoint, is this really worth pursuing, given all the information you've collected about your market, about who's involved, and what you're going to produce? And financial statements really help to answer that question. And when we talk about financial statements, we're talking about a balance sheet where we outline what do you own versus what do you owe somebody else. And the difference between those two things is the value of your business. An income statement's another financial statement that really talks about, did the business make or lose money in that year? And then also a cash flow statement, where really what we're looking at is we're using these other two financial statements to help us identify, where did the money come from? And then where did it go? And that helps us to understand a number of things about the farm as we think about growing our business value, about, are we making money? And we start to get an idea of, overall, does this really make sense? And if you're starting brand new, a lot of this is projection, because you're not going to have a lot of information to put on these statements. And that's fine. As you're starting out, the goal is that your business is going to grow. The idea is to think of this from a standpoint of, what steps do we need to take to put ourselves in position to make the business grow, to be profitable, to make sure that, when the money comes in, we know where it's going in back into the business and not going elsewhere. And eventually what you're going to have is much more information to put on these financial statements to track over time, to think about, how financially viable is the business going forward. And if you've been in operation a couple of years, especially even just in a hobby mode, you're going to have some good information that you can put on to these statements to kind of give you an idea of, hey, where's our starting point? Because we've been investing some money into this. Again, the hobby that got out of hand, well, there's some value there that you can put on these statements to tell you, hey, how viable is this, given I've already got a few things in place from what was a hobby already. Now, there's some really great resources that are out there. I want to highlight AgPlan. It's a farm business planning app. It's through the Center for Farm Financial Management. And don't worry about scrambling to include the link here. I know Anna is going to get in the chat here in a moment. We're also going to make sure it's available at the end for you to capture as well. But this is a really great resource where you can look at templates of other business plans. There's an editor feature in there. There's some tips and kind of a sample to look at, but then also there's an opportunity to have some folks review what you've written and give you some feedback on where maybe you want to try to strengthen some of your sections in there. Really, really great resource. Really recommend it for people that are looking at business planning. So I've been talking for a little while now, and I mentioned that we were going to discuss where farm budgets really fit into this whole picture. Okay. And so I'm going to make good on my promise, and we're going to talk about that. But first off, we have to identify really what are farm budgets. And these are really your goals for the year. We think about these as numbers, but they're really talking about our production and our financial achievements that we want to reach at the end of the year. They're also a reflection of the farm's capabilities and its concerns. We go back to that SWOT analysis, our strengths, our weaknesses, opportunities, and threats. They're all in this farm budget in one way or another. And they're also something that's really got to be based on reasonable and accurate expectations. We think back to historically what our cost of production has been versus what it may be today or going forward. We want to be reasonable with our expectations of what goals we're trying to achieve and what capabilities and concerns the farm really does have. But more importantly, a farm budget is an outline of the path to success. What can we do to achieve our goals? Now, with that in mind, this phrase here, cost of production, comes up quite a bit. And often we get asked the question, okay, why is cost of production such a big deal? Well, managers improve their decision making by understanding past performance. And if you're thinking about going into a farm business, that's going to be one of the things you want to be able to do is we want to improve our decision making. So we want to understand what we've done before to help us make better decisions going forward. And cost of production is a financial representation of our past performance. How much was produced? How much production, how much was production sold for? What did it cost us to produce the farm products we sold? And ultimately, did we make any money? And when we compare the current budget to our cost of production historically, or maybe there's some industry numbers of cost of production that we want to look at, it helps to guide and improve our overall decisions. Now, one of the tough questions that comes next is, okay, it's important. Now, how do we find cost of production? And I think that the best way to think about cost of production is first to understand what it is and what it is not. Cost of production is not only your input costs, those supplies you buy every year. If you got bees, you're maybe buying sugar. There's some containers maybe for honey. You may have some chemicals for treatments you're buying, fuel expenses that you run into every year. What it is instead is all your cost to operating. You've got the same things, the same variable input costs of supplies you buy, but then you've also got some of these things we call fixed cost or overhead costs. Maybe there's some liability insurance for the farm that you've got bought. Maybe you're having to rent some land to put your operation on, or you've got a building that you're renting from someone. Maybe there's some labor involved. You got some employees that you pay them about the same every year. It's pretty steady income. There's also this idea of depreciation. Now, earlier I talked about depreciating assets on your taxes. This is a different type of depreciation, which gets very confusing. This is what we call an economic depreciation, where we think about the wear and tear on assets over time. Well, as something gets older, it gets less valuable. I often talk about how a tractor today is going to be worth less a year from now. And so you think about that lost value. Well, that impacts the overall value of your business. And so we treat that as kind of a cost to the operation and thinking about, well, how much more income do we have to generate to kind of capture that cost? We can spend an awful lot of time on depreciation, but something you want to be aware of that it is a part of your cost of production, and you want to be able to kind of think about what that is in more detail. Now, something that cost of production is not is based solely on your tax returns. And there's a really good reason for that. Your tax returns have multiple years worth of income and expense, up to possibly 3 years worth. you could have an example I've got here on the screen. You could have receivables and inventory sales that came from 2020 that maybe you realized from in 2021, but they actually were from the year before. You could have production sales and costs that actually happened in 2021. And then maybe you've got some prepaid expenses that you bought at the end of 2021, but you're really going to use them this year in 2022. And so you've got this mix of different years worth of income and expenses that are kind of muddying the waters on what cost of production should be. And that's where we want to get to more of this production year based view, where we're thinking about only the things that were really part of the actual year. And so in this example, we want to think about only the sales and the costs of production that were incurred for 2021. We want to think, and so the things we actually cash transactions that were actually for that year, prepaid expenses that maybe we bought in 2020 that we used in 2021, well, those were for 21, so we count those. But then we also want to think about any receivables or inventory value that maybe we didn't get them in 2021. We've probably realized them already here in 2022, but they're really not part of this production year. They're last year's income. And so we kind of do this a little bit of shifting where we want to be able to go from looking at taxes to more of this production view. So that raised the question of, all right, how do we go from taxes to a production year with these numbers? And I've got an example I want to show you where it's actually a kind of a simplistic example of how you could do this, but it's really not that complicated. Although the key is going to be how good is the information in your farm records, and we'll come back to that a little bit too. So let's talk about this example here where we're going to use our financial statements, going back to the income statement, our balance sheet. And what we start with is what we would consider a cash income statement. It's basically our tax return. What we filed our taxes on as a farm business, we listed that we had sugar that we spent $350. This was the cash transaction in the year, but we had prepaid the year before $100 worth of sugar. And we also, at the end of 2021, we had prepaid for some sugar to use this year in 2022. And so we do these pluses and minuses where, okay, what we bought at the end of 2020, well, that really belongs in 2021. But we also spent some money here that really belongs in 2022. And so we add the 100 to the 350, we subtract the 150, and we come up with this actual production year total of $300 that was spent for the farm on sugar, which is $50 less than what we had in on our tax return. We've got this example, it's a honey production example with 10 colonies. Simple math, divide by the 10, you've got $30 per colony on the sugar. We do the same thing with the glass jars. We spent on our tax return $475. We had prepaid $300 the year before. We use that in 21, so we add that. So now we're up to $775. But then we prepaid for 2022 in this amount, $250. So we subtract that and we end up with $525 worth of glass jars. So about $50 more than what we had on our tax return. And again, simple math, divide by 10 for our colonies, and we've got this idea of $52.50 per colony. So we've done this this production year, or what will be a technical term of accrual adjusted, but I like production view because it's much easier to swallow and say. So we've got this actual information. We know now what our production year was. What do we do with it? How do we use that to help us make some decisions? Well, this is where we go back and look at what our planned information is. And we can look at this a couple different ways. If this is our plan of what we started the 2021 year with, then we look at it and we can draw some conclusions about maybe how the year went, or at least we're going to pick up on some indicators of the things we maybe want to look at for our farm business. And this again gets to thinking about our for-profit activities, our business-like manners that we want to be thinking about. So let's start with sugar. Our actual amount was $30 per colony, but our planned amount was $24. And so this generally starts to ask the question of, okay, what was different? Did we not plan enough packages? Did we end up using more than we thought? Was the price higher than what we expected? Or maybe we had something else. Maybe we had a big accident on the farm and somebody dumped a whole bunch of sugar on the ground. We couldn't use any of it. But you start to ask the question of, why is there a difference? And is the difference something that we can manage and control, that we can do differently in the next year that we want to be thinking about? Or is it something out of our control that maybe we need to think about? Okay, is there some kind of risk management tool, some way that we can think about mitigating the risk that we're experiencing on this item that helps us to improve that number to be closer to what we had planned? So that when we go forward, we're trying to keep that cost more in line with what we originally expected. The other side of that coin is, were our expectations reasonable? And that's something you can sit there and think about as you're thinking back of what decisions you made, your production practices. Was there a decision that we should have changed our thought process there a little bit? We can do the same thing with glass jars, where in this case, we planned for more, a higher cost of $55 per colony, and what we had was a little bit less, $2.50 less. And so we asked the question of, okay, again, what was different? Was the price better than what we expected? Did did we not have as many production, so we didn't need as many jars? And so again, you're trying to think of what the reasons are behind some of these differences in the operation. And so the other side of this too is, as you go to plan forward, maybe you flip the script on this, and this is actually your plan for 2022. And you've got this information, you're thinking, okay, are our expectations, again, are they reasonable? Are we really kind of basing ourselves back on what what we've been able to do in the past? And so you use this information in a multitude of ways to think about, how do we improve, what can be changed, or in some cases, maybe we want to keep doing what we were doing because it was successful. And so it's not always about what was the bad, it's also what was really good that we want to kind of maintain going forward. We can kind of see the same thing if we look at another example here, where we go forward and think about it from an income standpoint. So same thought process, but we're gonna kind of shift how we do the pluses and minuses here a little bit. Now we're talking about income, but we're still using our balance sheets. We're still talking about an income statement, our tax return information, basically. We had $7,000 we reported on the taxes. We had receivables at the end of 2020 that we realized here, and that's part of the 7,000. It was realized in 21. So those really aren't part of the 2021 income. But at the end of 2021, we had $2,500 in receivables that we probably realized them now in this year. But they weren't there originally at the end of 21 for us to claim on our taxes. And so in this case, we subtract the receivables from the year before. We add in the receivables that were actually received a year later to come up with this actual production year view of $7,500. So $500 more in total income than what we actually had for the operation on our taxes. We look again at our colonies, same farm example. We've got $750 per colony. We know from our production, so now we're pulling in our production records. Now we've added some other information into this. We know from our production records that we had about 65 pounds of honey. And so we come up with this price that we were able to receive of $11.54 per pound. So again, what do we do with this information? It's really nice and helpful to see, well, but what do we do with it? Now let's go back again to our thoughts on our plan. let's flip the script here and think about what did we actually plan going into 2021. We think of the price. Well, we were expecting a little bit higher price, but we didn't really get that when everything was said and done. And so the question may be, why is that? What did we have some issues when we were selling? Is it a case where we were setting the price? Were we working through a farm market of some kind where we had to, some kind of pricing strategy? We had to deviate from this. Was it a case of, we didn't plan on 60 or 65 pounds, we only had 60 pounds, but what did we do that generated the 65 pounds? Was it just a good year? Did we do something, did we make a decision that impacted that we saw the increase in the pounds of honey that we had? And if so, we maybe want to do that again. And then we kind of look at this idea of, okay, we realized $750 mainly because of the increase in production based on what we had before. And so you start to think about, well, wow, what do we do that if it was, production wise, what do we maintain that we don't want to make sure, we don't want to change anything there. If anything, we want to repeat what we did, but what can we change maybe about the way we're pricing things? And if you flip this and you're thinking about moving on to next year, maybe we feel we're going to do a bit better on marketing. Maybe we understand 65 pounds was maybe a little bit, it was kind of one of these things that we're not really sure what really caused it. So we're going to be a little bit conservative. And we know that we're going to be just a little bit less of what we had originally gotten the year before, but we have some reasons why we're maybe thinking about that overall, understanding that maybe we don't fully understand what the production changes were, and we've got to spend some more time really researching that. To be able to do this kind of analysis, and this is very simple analysis when you really get down to it, because really what it amounts to is we're pulling this information out of our farm records. And this is why farm records must have details. When you're looking at expenses, feed can't just be feed. You have to put some detail in there, even if it's just a single note that, hey, this feed that we bought, this was sugar, or this was protein patties. Or maybe when you've got the treatments, we've got a couple different treatments listed here. I'm not going to try to pronounce the names here, but maybe you're doing different things with the treatments and you're trying to track what was, really cost effective. I spent the extra money on a certain treatment. Did I really see a benefit out of it? And then the same idea with income. If you've got multiple income streams, if you're doing honey and you're selling the bee queens and you're trying to figure out where you're making your money, you need to be able to understand what the units sold were and what the prices received are for each one of those, because then you can kind of start to pull that information out. And what's really important is whatever information you want to track, that's the type of detail you want to put into your farm records. And so you want to think about, what are the type of things I want to know about my farm business to help me to improve it, to think about what things make me more profitable, what things I want to continue production practice wise. And those are the types of little notes that you want to start to put in your farm records. And you're going to discover over time that certain things are not really valuable to you as much as you thought the first time around. Other things are, and you're going to maybe change that a little bit as time goes on, but you want to start to keep some details. And that's why, details are a must for success. And to kind of bring this in to really think about this another way, farms typically track production details. The question is why? Well, production helps us to understand what the farm's abilities are. What's our production history? What's our potential? We've been able to do it in the past. We should be able to do it again type thought process. From a production standpoint, it helps us to recognize our areas of concern. What are our limitations to reaching that potential production? And then it also helps us to address concerns and improve performance when we think about that production mindset. Most farms are very production oriented and do this, a lot of cases, very easily and without putting too much thought into it. But the same thought process really applies to your farm records. By keeping the details, you start to understand what the farm has achieved. We start talking about profitability, cash flow. Where'd the money come from? Where did it go? And overall, is our business growing? Are we increasing the value of our business over time? And when we have those details, it allows us to really do some true comparison to the industry, whether you've got some actual farm by farm comparisons, or even if you're hearing in the news, hey, the farms are seeing these kind of expenses on average, or these kind of expense hikes. It helps us to go back and look at our own information and say, well, are these areas of concern that we have as well, or are we maybe doing a little bit better from what we're hearing other farms are experiencing? But at the end of the day, our records are also our foundation to this year's plan, and they're going to give us the detailed records that provide a guide to what we want to be able to achieve down the road. And as you're thinking about getting into this idea of, am I going to shift from a hobby into a business, you want to start thinking about those details as your guidebook to be able to really think back to what is my overall business plan, my business goals, what am I passionate about, what do I hope to achieve, and am I getting the information, am I tracking the information to help me to really capture that and think about that. And as you're kind of on the fence about, do I want to go from a hobby to a business, these are the things you have to start thinking about, of tracking the expenses, tracking those profit activities, and really thinking about, is this really what I want to do? If not, perfectly fine. But if you do, you start trying to put yourself in the right motion of developing these habits so that you can have the success that you want out of the business you're trying to develop. Last thing I want to kind of highlight for everybody is some resources that we have through MSU. There's a beginning farmer series that I actually coordinate, called the Demand Series, developing and educating managers and new decision makers. We have a lot of different resources, some very specific to certain production types, some more general. One of the things I want to highlight is, you're thinking about going from a hobby to a business. We have a resource guide on farm management experience, thinking about how maybe you want to start developing your business that might be helpful. We also have a bulletin on introduction to cost of production and its uses, kind of covers some of the things that were talked about tonight, but gives a little bit more examples. And those are available at the website here. I promise we're going to share that again here in a moment, so don't try to scramble to write that down. I also want to highlight that we do have some assistance available through the MSU Telfarm system and extension. Telfarm is an educational service program. It's designed to assist farmers with their financial records and decision making. The biggest thing that I encourage people to think about it for is receiving record keeping support. You can turn in your records, basically turn them in monthly. They can get reviewed. Anything that you're having trouble keeping track of, any errors in your counting, it's computer based, or you can do it by hand. A really good resource for that kind of support. We also offer through Telfarm financial analysis, which is a much more in-depth look of getting that production view on things and converting those tax records into that production view. And then we don't have a lot of beekeeping information in the what we call a FinBin benchmarking database, but any farms that participate do add to that, where we hope to be able to eventually have some industry numbers of comparable farms of similar size to actually help look at that. But we definitely are short on those numbers. But anybody that's involved in the program that goes through that process, we do get to contribute to the database. And the last slide I want to leave up here before we get into questions is all the resources I promised I'd put all these links back up on the screen for. And so we have those available, and go ahead and open it up to questions.